This year, however, we may not be so fortunate. Events in just the first month of 2026 have already been of exceptional scale and consequence. They have increased geopolitical tensions worldwide. As pressures build and the margin for error narrows, the resilience of the global system will be tested far more severely.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcasts. My name is Ewan Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore, and today is Friday, the 13th of February. Geopolitical uncertainty was a focus at the start of the year, and it certainly remains top of mind among policymakers, as you heard there from Singapore Prime Minister Lawrence Wong in his budget speech. But markets seem to have shifted attention to the data and other country-specific events. In the US, we had the delayed jobs report, which showed a drop in the unemployment rate and a significantly higher than expected non-farm payroll. But market reaction was a bit mixed, with US Treasury yields picking up while equity markets and the dollar taking it in stride. We speak to Jeremy Schwartz from our US economics team in New York to digest what that says about US labor market conditions and the implications on Fed policy. In London, George Buckley, our chief economist for the UK and Europe, will preview UK CPI and labor market data and discuss some recent political developments as well as flashpoints to watch. In Japan, we had, of course, the historic landslide win of Prime Minister Takaichi's LDP, and the yen strengthened alongside a rally in equities, while long-end JGB yields declined. Yuichiro Onosaki from our economics team in Tokyo joins us to discuss our post-election thoughts on fiscal and monetary policy in particular. For the rest of Asia, China and some other markets will be out for the Lunar New Year holidays, but we still have a few central banks on tap, the RBNZ, Bank Indonesia, and BSP from the Philippines, which we expect to have diverging decisions and tones. That's really consistent with the central bank divergence theme that suddenly emerged globally this year and running more on local considerations, which is why in this episode we are dedicating a special segment to zoom in on the outlook for rates markets in the region with our strategists Andrew Ticehurst and Albert Young. So let's dive in. Okay, let's kick off with the US. Hey, Jeremy, thank you again for being here. We've had the jobs report this week after some delay, and payrolls were significantly higher than expected. What's your assessment in the back of that of US labor market conditions at this point?
Hey, Ewan. Yeah, it's great to be back on the podcast. This was a very strong report, kind of hawkish surprises across the board. And we had been above consensus on the job gains, but I think even we were pleasantly surprised to the upside. That said, I think we're thinking about this report more as a normalization after some weakness last year, rather than the start of a decisive trend of reacceleration in the labor data. And there are a few factors that make us think this report was a little bit noisy. For starters, you had a significant jump in education and health employment. That's been one of the strongest sectors recently, but it actually added 137K jobs. So that's the strongest in many years for that sector. This was coming at the same time where the BLS has revamped some of their methodologies around things like birth-death adjustments, how they account for new businesses and closing businesses in a way which we think is probably going to add some additional volatility to the data. So again, I think it's very reassuring that you're not getting a continuation of the slowdown last year, but we don't really buy the strength of the rebound, especially in the headline job numbers. Similarly, on the unemployment rate, this was another pleasant surprise. We'd been expecting a decline to 4.3, but consensus was higher at 4.4. So you saw the move lower, but I think there's still not so many signs that you're getting a sustainable downtrend in the unemployment rate. We would, again, frame it more as you had some noise to the upside last year, and now you seem to have corrected lower. And the biggest factor there is we still haven't seen measures of labor demand or job finding really start to pick up momentum. So things like JOLTS job openings, the consumer confidence labor differential, and other survey measures of households looking how easy it is to find a job have continued to trend lower, even as we've seen the unemployment rate stabilize. And then if you look at the guts of the household survey, I think there's some more concerning signs there as well. So fewer unemployed workers found jobs in the month. And you saw most of the decline in the unemployment rate was just driven by kind of a drop off in layoffs. So that's good news, not great news. I think there's a lot of evidence that the unemployment rate overshot last year. We think that the current readings are a little bit more consistent with broader labor data we've been seeing, but we're forecasting further declines in the unemployment rate later in the year. And I'd say we've yet to get confirmation that that trend is really underway. So I think it's more likely in the near term that you just chop around. Finally, on the income numbers, those were quite strong as well. So average hourly earnings surprised to the upside. You had an uptick in the work week. So private labor income rose 0.8%. That's the strongest in several years. So that's going to support consumer spending going into the year at the same time that you're getting some additional cash flow support from the One Big Beautiful Bill Act and the tax refund checks, which are going out just around now.
Yeah, got it. And yeah, interestingly, despite the surprise, it seems like markets reacted differently with the dollar and equities seemingly taking it in stride, and only U.S. Treasury yields seem to be picking up a bit more notably. So that's interesting. In terms of the week ahead, Jeremy, we still don't have the CPI numbers that are at the time of this recording. But what do you expect from the core PCE release next?
Yeah, so the January inflation data has been noisy to the upside for many years now, and we do expect that trend to continue. So we think that the residual seasonality, which pushes up U.S. inflation data to start the year, is likely to persist. Some of that is just about service sector businesses, which only adjust prices once per year, which typically is at the start of the year, and it's very difficult to seasonally adjust. So when you're in a high inflation backdrop, you tend to get these upside surprises in January. On top of that, we think there's some lingering pass-through of tariffs for this report. So basically businesses that are trying to be opportunistic about price increases using the period just after holiday discounting typically ends to sneak in some price resets higher. And then finally, if you recall, October and November inflation data was extremely weak, partly because it was poorly measured due to the government shutdown. And we think there's actually going to be some positive payback in the January numbers for that as well. In particular, a lot of inflation components are only measured every other month. So if November was artificially low, it's actually going to be in January where you get some of the payback for that. So, for all those reasons, we think you're very likely to get a hot core CPI, hot core PCE prints for January. This isn't going to mark a reacceleration in inflation, but we do think that it keeps the conversation about inflation risk skewed to the upside. We ultimately think the tariff-driven inflation is going to ease through the year, but it's actually peaking right around now. So until you start to see the sequential numbers really come down, we think it's going to be important for the Fed and markets to remain focused on that risk of persistence, the risk that inflation does get stuck closer to 3% than 2%.
Yeah, and on that note, any implications on your views on the Fed?
Yeah, so we had expected that the Fed were done cutting so long as Powell remained chair. I'd say the labor data really helped to drive that issue home. And on top of some of the improvements in the unemployment rates, beyond just the strong NFP numbers, I'd say a lot of the details of the data that had been singled out by dovish Fed members as reasons for concern actually eased as well. So unemployment rates for more cyclical groups like 16 to 24-year-old workers fell. We saw a drop in the number of people who were part-time for economic reasons, that U6 underemployment measure. So a lot of these supposed canaries in the coal mine, which were noisy to the upside late last year, have now corrected lower. So, as I mentioned at the outset, we think the labor data was reassuring, but I think even the nuances will really help to take the firepower out of some of the dovish arguments that the Fed should continue easing rates and should remain concerned about labor market downside risks. So I think the Fed minutes, particularly because they're backward looking, could help to highlight that point. If you saw people arguing for rate cuts and then the subsequent data seems to go against them, I think that ought to be consistent with the view that they're likely to remain patient, that the labor market is not telling them that they need to be in a hurry, and that inflation data, even if it's just because of one-off factors, is likely going to keep the pressure on for policy to remain restrictive.
Okay, brilliant. Yeah, thanks again, Jeremy, and speak again soon.
Yeah, thank you.
All right, let's swing over to London, where my next guest is joining me from. Hey, George, thanks very much for joining.
Hi, Ewan. Thanks for having me on.
So for the week ahead, we have some important UK data, CPI and labour market report. What do you expect, and how important are these for your Bank of England call, which you've changed recently?
Yeah, they are very important. We did change our call just last week because the Bank of England was very dovish, and we decided that the next move was more likely to be in March now. We brought that forward from April, and another cut we added to the mix for June. So we now have a couple of cuts, the next one next month. So you're really going to need to see some data to present itself in a weaker fashion to be able to get that. And I think it will. I mean, I think the CPI numbers, the inflation data next week will come down further. Now, some of that is going to be due to base effects, but we do think that inflation is on a downward path. One interesting thing from the Bank of England last week, they published an inflation forecast, and from Q3, so the second half of this year onwards, they don't have a single quarter with inflation above the target. Now, that's a very big difference to what they'd been publishing before, and it's very encouraging. So I think that alone will be helpful, very helpful for the bank. But other data next week as well, we need to focus on include the labour market report. There'll be a lot of focus on wage growth, which has been slowing, and also on unemployment and employment. Unemployment, the bank thinks, is going to rise further. Employment has been softening. So lots of activity data in that report to watch out for. Other things, we've got retail sales data, we've got survey news, particularly the PMI surveys, which have been pretty strong for the UK. I wonder whether we're going to get some payback there. But a lot of data from the UK, including the public finance numbers, I should add. That's important because they're the last set of budget deficit data before the spring statement. Of course, the spring statement is no longer going to be a fiscal event, just purely a statement, but still they're important.
Yeah, very interesting. You'll hear later in the podcast some differentiation here with, for example, RBA already hiking, and then you've got Bank of England still on a cutting cycle. What about Europe, George? What are you expecting there for the week ahead? Some important data as well?
So some data, not quite as big as the UK, but still very important. We have those PMIs, and interestingly, the PMIs are much better correlated in Europe with economic growth than they are in the UK. So there'll be a lot of focus there. And I think the two bits which will be in focus, in particular in the euro area, is Germany starting to be supported by some of the increased fiscal spend that we're seeing? And secondly, the French composite number was below 50 last time. Might that bounce back up? So a couple of questions we need to ask there, but there's other surveys as well. The ZEW survey, we've got euro area confidence data, consumer confidence, and there's some actual hard data in the form of industrial production and construction output. All of that for next week. And finally, one more point is that we do have euro area wage growth numbers as well, wage settlements, negotiated pay. It's probably going to be in the low 3% for Q4 last year. That's what certainly the trackers, the ECBs and our own trackers are suggesting.
Okay, great. And then finally, George, there's been quite a bit of political noise as well in the UK. How important do you think are these for markets, and any quick thoughts on what flashpoints you're watching in the near term?
Well, to answer your question, very important indeed. It looks like everyone, all the cabinet members have come out in favour of Keir Starmer, the current Prime Minister. He looks like he has survived this crisis, which is encouraging political stability. But there are a couple of major flashpoints over the course of the first half of this year, which we need to watch out for very carefully. The first one is a by-election, an election for an MP on Thursday, the 26th of February. If Labour loses that, then it could certainly add to the malaise amongst Labour MPs. But I think even bigger than that is the May the 7th elections, the local elections. And if Labour does very poorly there, and incumbents often don't do well midterm, as we know, then there is a real risk that somebody could put their head above the parapet and decide that they want to stand for the leadership. But unlike the Conservative leadership elections, you do need to have someone actually raise their hand and say, it's me, I would like to stand for it. You can't just simply put some anonymous votes in a ballot box and say, we don't want the current Prime Minister or Labour leader. It has to be somebody deciding that. And so that makes it maybe a little bit less likely, but still something to watch out for after those local elections.
Yeah, got it. Interesting point on incumbents, because the elections we've had in Asia so far, the incumbents were doing very, very well in Japan, but also in Thailand over the weekend. So, yeah, we leave it here. George, thanks very much. A lot of things to watch.
Super. Thanks, Ewan.
Now let's go to Japan, and I'm very happy to be joined by Yurichi-san from our Tokyo office. Thanks, Yurichi-san, and welcome back to the podcast. A lot to discuss in this post-election scenario. So obviously the LDP won a historic landslide with more than 2/3 of the seats in the lower house. What do you think is the most important policy implication, I guess, particularly from fiscal policy?
The LDP won 2/3 of the seats, making it possible to pass in the lower house bills that were rejected in the upper house. This reduces the need to make concession to the opposition parties. The Takaichi administration has so far advocated a responsible and proactive fiscal policy. Since the LDP will not have to accept expansionary policy from oppositions, the possibility of placing greater emphasis on responsible has increased. After the election, super long-term JGB yields have declined, which suggests the market is leading it in the same way. In its manifest, the LDP said it would accelerate consideration of temporarily cutting the consumption tax on food items. It had stated that discussion will take place in a cross-party meeting, and after the election, Takaichi has emphasized that the tax cut would be limited for 2 years and would not be financed by issuing additional deficit-covering government bonds. A direction is expected to be presented before summer. In June, Takaichi administration will publish its first basic policies for economic and fiscal management and reform. How responsible is its fiscal policy needs to be confirmed through the discussions over the consumption tax cut and in that basic policy document. In addition, Takaichi is scheduled to meet Trump in mid-March. The US side appears increasingly wary that Japan is exerting upward pressure on US long-term interest rate. Thus, Japan now needs to be mindful of US concerns when conducting its fiscal management.
Okay, that's really interesting. So fiscal responsibility seems to be the focus now. Now, when it comes to the BOJ, how does it impact our baseline forecast of rate hikes this year, and any risks around that?
The main channel through which fiscal policy is affecting inflation is not by improving the output gap, but it's by pushing the yen weaker. After the January MPM, there were moves that looked like a rate check between Japan and the US, and recently the yen is appreciated toward dollars. So we are not in a situation that's pressuring the BOJ to hike rates earlier. Our base case is for the next hike in June, but if the yen starts to weakening again, we'd consider bringing that forward to April. Also, Reuters has reported that the successor for the two BOJ's board members, whose term ends at the end of March and June, will likely be presented on February 25. There will be Takaichi's first nominations, so they are important for gauging its stance on monetary policy and how much it's thinking about market reaction. If more dovish members were appointed, that could increase the chance of another depreciation of the yen.
Okay, got it. And then finally, on the week ahead, any data points you're watching?
2 things to watch next week. Monday's release of Q4 GDP and Friday's nationwide CPI for January. On GDP, Nomura is forecasting an annualized 1.7% quarter-on-quarter growth, which is closer to market consensus. But the high growth looks like a rebound from a temporary weakness in Q3. Looking at monthly data, capex is strong, but private consumption remains weak. So I don't expect the print to be the sort of strong surprise that would force the BOJ to hurry into a rate hike. For CPI, we expect core CPI, inflation excluding fresh food, to slow to 2.0% year-on-year. Food inflation is easing, and the government measures to cut gasoline prices are also taking some pressure off headline inflation. Also, we have to keep in mind that Japan is planning a CPI revision this summer. So the inflation rate from January through June this year will be revised retrospectively. There's a historical tendency for those revisions to be downward, so that's something to be aware of.
Okay, that's excellent. Thanks very much, Yurichi-san.
Thank you.
All right, now for this special segment, which I'm really excited about, we'll do a bit of a deep dive on Asia-Pacific rates markets. And I'm very delighted to be joined by Andrew Ticehurst, who you would know is a co-host of this podcast, but his day job really is our Australia and New Zealand rate strategist, along with Albert Leung, who heads up our rate strategy for AEJ based in Hong Kong. I would note both also just published very interesting anchor thematic reports recently, which I'll ask them to discuss here too. Welcome to you both. And again, special thanks to Andrew for joining despite being on the road in Tokyo at the moment. Let's start with your special report. Maybe you guys can give me a bit of a brief overview of the main conclusions of those reports. Maybe start with Andrew and then Albert.
Yeah, sure. Thanks, Chip, and great to be with you both. So in this special report, we took a deep dive into the Australian state government bond market, or what we call the semi-bond market. That might sound a bit sort of arcane to some listeners, but it is an important liquid little bond market, about $500 billion US in size, and it continues to grow and develop. These bonds are highly rated and offer good yield, and they are treated as high-quality liquid assets for regulatory purposes in Australia. Anyway, in this report, we provide a bit of background on the sector. We look at the state economic cycles to see who's doing well, who's not doing so well. We look at the state budgets, the borrowing programs, their credit ratings, upcoming elections, and then we offer some thoughts on relative value, which bonds we think are most attractive at the moment. So yeah, I think it's a pretty good special report for anyone who wants to get up to speed on the sector. There's a lot in there, and even for seasoned players in this space, I think the report's got something to offer as well.
Great. And Albert?
So we launched this special report, which is a China rates trading model. So we serve two purposes. So one is to highlight the key drivers of China rates, and the other is to give the likely direction of China rates over the next week. So for the key drivers, we backtested quite a lot of series. So we eventually choose 11 and group them into three categories, which is liquidity, technical, and macro data. So we only select a series with a daily and weekly frequency because most top tier data had the problem like inflation, credit, and retail sales. They are only available monthly. So in the past 2 weeks, the model actually have given a mild receiving signal, and rates have indeed moved lower. And just lastly, I'll highlight the average win ratio of this model is quite good, right? Around over 60% since 2023. It has higher Sharpe ratio than a few benchmark China government bond funds. So yeah, we hope this is something that our clients will find interesting.
Yeah, fascinating. Yeah, thank you both. And yeah, I would encourage everyone to have a look at those reports for more details. We won't have time to sort of go through them here. And now I also wanted to get your views from both of you on the rates markets overall. But before that, we have some central banks in the region that we can preview in the week ahead. So let me start with Andrew. We have the RBNZ. What do you expect there next week and even further out?
Yep. So for the RBNZ, we're very confident they'll announce an unchanged cash rate of 2.25% next Wednesday. They don't always publish a vote count, but if they do, it'll probably be a unanimous decision. But I do think the communication that comes with that decision is going to have to pivot in a more hawkish direction. Recent growth and inflation data in New Zealand have been strong, and it looks like that momentum is continuing. So I think they'll have to reflect that in their language. One thing to look out for, this will be the first policy meeting under the new RBNZ governor, Dr. Anna Bremen. She's joined from the Riksbank in Sweden. So the communication could come with a different sort of flavour. So it could be a few surprises there. But yeah, all up, no change to the cash rate. Very, very confident of that.
Okay, great. Not quite the RBA yet, which already hiked, but slanting in terms of the tone, seems like towards there. And speaking of Australia, Andrew, we have the employment report as well next week. What do you expect there, and what does it do to your outlook on the RBA from here?
Yeah, sure. So we've got employment rising by around 20,000 in the month of January, and the unemployment rate staying the same at 4.1, actually to a couple of decimal places. It rises a tiny, tiny fraction from 4.10 to 4.13, but anyway, rounds to 4.1. The unemployment rate, we do have grinding higher over the course of the year. The economy here is going to be hit or face some headwinds from tighter monetary policy, tighter fiscal policy, and a higher currency. So we do have the economy losing momentum as we move through the year, and the unemployment rate rising to about 4.5 by year end, but probably not much change in this monthly data this time.
Okay, great. Thanks, Andrew. For the rest of the region, we have a couple of other central banks in the week ahead. So BSP in the Philippines and BI in Indonesia, both on Thursday. We expect BSP to cut by 25 basis points, so delivering another easing. Primarily because growth has really been underperforming as a result of the ongoing corruption scandal, and inflation is also quite benign. So that gives BSP some leg room to continue to focus on supporting growth. The language, though, I think will be less dovish, which is similar to what we heard in December. So this will be a relatively hawkish cut, I suppose. And then for Bank Indonesia, we have them on hold, I think because the external backdrop is not yet supportive for a cut. And I would argue there's some balance of payments pressures that are threatening their FX stability objectives. So I think they will keep the policy rate unchanged because they are still a little bit more cautious than that. But unlike the BSP, the tone will be dovish. They will retain this assessment that they still see scope to ease further because inflation is within target, and they feel the need for growth to be supported as long as external conditions allow and the IDR remains stable. So we have BI actually still cutting in March and June, so a total of 50 basis points, and not quite over in terms of the easing cycle. But again, if these balance of payments pressures persist, I think there's a risk that they could delay the start or the restart, I should say, of the cutting cycle. Albert, just want to ask specifically on Indonesia, any thoughts from a rates perspective?
Yeah, thanks, Ruben. So Indonesia bond yields have been moving higher since the start of the year by about 20 basis points. Offshore has also been selling. So at this level, though, I think the front-end bonds up to 5 year may be better supported because 5-year bond at 5.75 now is still around 70 basis points above the 12-month SRBI bills. So as you say, a couple more cuts, and even if it is delayed, I think should still cap the front-end yields. The long end, I'm a bit more negative. I think the fiscal concern is still there. Bond supply also risk. So so I think the 10-year bond will be more negative.
Okay, got it. And what about the broader Asia region? I know there's been quite a bit of divergence, like we've seen globally, particularly from a central banking perspective. Do you agree with markets pricing in some countries a hike already, or are those overdone? But also, I want to hear your thoughts as well on the rates markets in China.
Yeah, sure. So to some extent, I think some markets a bit overdone, like Taiwan. So it is pricing hikes now in both June and September against a backdrop of stable inflation and property market as well. So it seems a bit too much. But overall Asia growth data and PMI have been solid. So for some markets like Korea and India, I actually think the rate hike pricing could sustain, even if the central bank says that they're in no rush to hike. So in those two markets, I think curve flatness could perform. And lastly, on China, right? So we can probably answer you better tomorrow when the new signal from our new model comes out. But of course, right, this is only this is a model actually to complement our medium-term framework. So from here on, I think China rates have some room to go a bit higher. So partly on the ahead of the March MPC, maybe more fiscal stimulus to come. And I think the overall China risk sentiment should stay okay ahead of the potential Trump-Xi meeting in April as well.
Okay, great. So a lot really hinges on central bank decisions and their outlooks to drive market pricing. Thank you both, Andrew and Albert. This has been fascinating.
Thanks, Ewan.
Thanks, Ewan.
Well, that's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out nomuraconnects.com for more of our research and updates. Have a great week ahead. And to those who celebrate, Happy New Year of the Fire Horse.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.